Hello and welcome to the show. I'm Puneet Wadhwa. Today we have with us Harsha Upadhyaya, President and CIO for Equity at Kotak Mahindra Asset Management. Welcome to the show, Harsha.
Thank you, Puneet. It's my pleasure.
Do you think the regulators have been successful in averting a global financial crisis after the collapse of select banking giants in the US and in Europe?
At least for now, while the overall outlook still looks a bit challenging, seems like they have acted very swiftly, and we have seen what has happened to SVB, for example. It was contained quite nicely within a couple of days. There has been a management control change as well. So to that extent, we believe that some of these issues are well contained at this point of time. We'll have to obviously cannot rule out more volatility given that things are still fragile and we need to monitor that.
Okay. So how do you think the global central banks will approach the monetary policies in the next few months? Have the discussions on quantitative easing come back to the table yet, according to you?
It's a little premature to talk about change in monetary policies, according to us, because finally the monetary policies are also driven by what happens to inflation. And inflation across the board, across the globe, has been at higher levels, much higher than what the comfortable levels are for respective central banks. So to that extent, we may not see a reversal in terms of the monetary policies, but yes, maybe the sharp and frequent interest rate hikes that we were seeing in the past, as it is, were anyways expected to slow down a bit, given that we have already seen quite a bit of frequent interest rate changes. But given what has happened in the recent past, maybe there will be some rethink in terms of the pace of interest rate hikes, but one can't say that monetary policies will get reversed anytime soon. Overall, I think the central banks will also try to calm the nerves of the market by probably are talking in terms of why it is required and how they are going to take care of overall economic health as well, while focusing on inflation and the various other issues that we are grappling with. Broadly, I would say that while interest rate hikes will continue, maybe the pace or the frequency could go down a bit, at least in the immediate term.
So, at a sector level, how should investors approach the banking sector stocks? Is it time to buy after the recent correction that we have seen, or better to wait out the uncertain phase?
While globally, banking sector seems to be under a bit of a challenge, but I would like to highlight here that none of the Indian banks are affected by what's happening in the globe. In fact, we have just come out of a long asset quality cycle, wherein most of the asset quality issues of Indian banks, both private sector as well as public sector, seem to have been taken care of. We have just started to see a bit of credit growth improvement in the Indian context. Given all this, we are at a very early stage of a new credit cycle. Very unlikely that you will have issues on credit quality at this point of time, either because of events that are happening in the domestic market or because of the international factors. So to that extent, at Kotak Mutual Fund, we continue to believe that banking will be one of the sectors which will probably give you a much better earnings growth as compared to the overall market for the next 2 years. Yes, there is a section of the market which believes that the margins could come under some bit of a compression. But even if you account for that, we believe that the earnings growth will be much better than the overall market average. And given that this sector has not participated in recent times in the market performance, we believe that valuations are also quite reasonable, and long-term investors can definitely look at this particular sector.
Given the global developments, Harsha, do you think that the banking sector back soon could probably see an aggressive push for consolidation, shoring up capital base, etc.?
You're talking in terms of the Indian banks?
Indian banking sector, the tier 2 banks, Indian banks.
Clearly, I think the linkages of Indian banks with some of the banks that have come under some bit of a stress is absolutely nothing. So to that extent, we don't believe that what is happening in the global markets will have a direct repercussion on the Indian banks, either in terms of asset quality or in terms of the need for further capital to strengthen the balance sheet, etc. So I think by and large, Indian banking system is insulated from what's happening in the globe. But yes, sentimentally, there will be a negative sentiments around the overall equity markets as well as a banking segment. So that we will need to deal with. But otherwise, I think on a fundamental basis, Indian banks are much better placed compared to some of the international banks which are coming under stress.
So what's your broad view on the markets? Are valuations now in a comfortable zone?
Yes, clearly, while we are still at around 17,000 Nifty levels, what we need to remember is these were the levels which were there in the market probably 18 to 20 months earlier as well. But at that point of time, it was probably towards 23 to 24 times 1 year forward the price to earnings multiple. But at the same Nifty levels today, having seen interim growth in terms of corporate profitability for about 6 to 7 quarters, valuations are more closer to fair range of valuation, something around 17 and a half to 18 times 1 year forward multiple, which one cannot say that it is expensive. Neither one cannot say that it is very, very attractive. It's I would say it is probably around the fair levels. So to that extent, while one cannot rule out further volatility in the markets, but any investor who is entering markets today for a 3 to 5 year perspective is expected to make reasonable returns from equities.
Okay. So, what is your average cash holding across the portfolios you manage, and how has that moved over the past few quarters?
Puneet, at Kotak Mutual Fund, we generally do not believe that taking active cash calls will help managing performance, because it's a double-edged sword. While you may gain when the markets are going down, but we have seen in the past as well, the recovery can also be very swift whenever sentiment changes or whenever fundamentals change. So to that extent, we really do not look at cash as a tool to manage performance. But yes, to manage liquidity or whenever we get consistent flows, if we believe that we can probably gradually deploy that rather than investing at one point of time in the benefit of unit holders, we do that. If you look at our cash levels, broadly, they have remained the same over the last couple of months. Most of our funds have been holding cash of about anywhere between 1 to 3.5%, except for our mid-cap strategy, which is currently holding cash in excess of 7%. Where we believe that the volatility could be higher if macro headwinds continue to remain. So to that extent, we will probably be a little more cautious on the mid and small cap basket rather than the overall market at this point of time. So to that extent, our cash levels are also depicting the same, wherein mid cap fund has slightly higher cash as compared to most of the diversified funds.
Okay. Flows into equities via the SIP/MF route are still holding up. At what point do you think that the retail investors will, start throwing in the towel, given the fact that the overall, macro environment globally still remains a challenge?
Puneet, clearly, investors have matured over a period of time. We have seen what happened during the COVID stress, and post that when the markets recovered, we hardly saw any change in terms of investor interest in terms of equities. And those who stayed in the markets definitely have seen benefits of long-term investment and disciplined investing. So to that extent, we don't expect most of the investors to panic at this point of time, especially given the fact that market has nicely corrected on a time basis for last 6 to 7 quarters. And also, while we have not made any great returns from equities in this period, we have also not seen a large downside. So our belief is most of the investors who have been long-term investors or who have seen the COVID disruption and the post-pandemic recovery will continue to bet on equities. And that's the right choice according to us. Yes, there could be further volatility or further sideways movement for some more time until you get a confirmation in terms of improvement in the macroeconomic environment. But as we have seen in the past as well, these are very, very difficult to predict in terms of the timeline. So to that extent, it's better to keep investing on a regular basis, keeping overall asset allocation in mind, as long as valuations are not expensive. And clearly, today's markets are not expensive in terms of valuations. So I would say that it's better to continue with the long-term approach and disciplined investments.
So what sectors are on your investment radar, Harsha? And which ones are the complete avoids?
Puneet, clearly, domestic businesses seem to be in a much better shape as compared to some of the export-oriented or global-facing businesses. The reason is very simple. Domestic growth is much more resilient than global growth at this point of time. There are more challenges to global growth and demand as compared to domestic economy or domestic demand. In that context, we have been preferring some of the domestic businesses in our portfolio as compared to global businesses. So sectors such as banking, auto, cement, industrials These are some of the sectors where we have a positive view on, and we believe that as domestic economy continues to remain resilient and continues to improve from these levels as we go forward, these are the sectors where there could be a reasonable improvement in terms of earnings growth as well as in terms of possibility of re-rating. So all in all, these domestic facing sectors are some of the preferred sectors at Kotak Mutual Fund at this point.
So one last question. Do you think that the next setback for the markets could come from tepid earnings growth over the next few quarters amid multiple headwinds such as inflation, possibility of, even a recession?
I don't think we should be worrying about recession in the Indian context. Yes, some of the Western markets could get into a situation of recession at some point of time in the future, but I think we can deal with that. And as far as earnings growth is concerned, already we have been seeing slightly lower than expected earnings growth for the past 3 quarters, and this has been driven largely by what has happened to commodity inflation and how profitability has got impacted because of higher commodity and input prices. In fact, we believe that over the next couple of quarters, this issue should get resolved, and that is what we are betting on from a medium to long term perspective. There is no point in worrying about the same factor even after 4 or 5 quarters. We believe that now, probably having seen valuations also getting corrected, it's time to actually look for recovery rather than further panicking at these levels.
Thank you, Harsha, for your time today. We hope to see you soon.
Thank you. Thank you so much.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.